Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to the Finance Garage. As always, it's Jonathan Wu here, Principal and Senior Financial Advisor here at the SW Group. Now today we're going to take a different lens. We've had quite a number of guests on the show so far talking about equities, talk about fixed income, and also where the superannuation industry is heading towards. Today we're going to take a different lens and look at an area that our practice has been investing in for the better part of 5 years through various different fund managers. And one that we've worked quite closely with over the last couple of years is Centuria Bass, which is an arm of the Centuria Property Group, who is an ASX listed company. And today I'm joined by Yehuda Gottlieb from Centuria Bass, who's the Managing Director. Welcome, Yehuda.
Thanks, Jonathan.
Just to start off, tell us a bit about your background. You lead the Centuria Bass business, and obviously, just for our listeners' benefit, what got you into private credit?
Yeah, so I've been involved with private credit since the late 2000s. I actually have an investment banking background more in the public markets, and we'll talk about the differences between them, but mainly started in the equity markets and around the GFC. Obviously the trends weren't looking great for those equity markets, and almost fell into it by accident. I sort of knew someone from the community who had started doing private credit or non-bank lending deals with property developers in 2010, 2011, and I joined that business at that time, not knowing a whole lot about it, but being a very junior member in a small team. And that business grew very rapidly. So I learned a lot about the business on the job, sort of fell into it by accident, but it was a rapidly growing sector. And now, 15, 16 years later, I'm very blessed and fortunate to have been involved in that burgeoning sector and seen the maturity of that sector along the way.
Do you think it is actually mature? Because I guess from a regulatory standpoint, private credit has come in, at least domestically, on the basis that post-GFC the banks have sort of pulled out. Do you think there is still a runway to growth overall for the sector?
Yeah, it's interesting. It has grown year on year, and there are sort of regulatory reasons for that and prudential reasons with APRA and more governing authorities over the banks and their balance sheets. But it's a trend that we've observed overseas as well. So in the European markets, there is a very healthy non-bank lending sector. In the US markets, it's even better. And a lot of that is proximity to capital. So in the Northern Hemisphere, in those larger markets, you find that there are a lot more banks and there are a lot more non-banks. And that's just because there's a lot more activity and cross-border jurisdiction and transactions that can occur. Whereas when it comes to Australia, we're so far removed geographically. We've traditionally been dominated by the big four banks, and other banks from around the world have come in from time to time, and their appetites for this, the risk profile that underpins some of the lending that we do has, waxed and waned over time. So there have been groups that have come in and dedicated their balance sheets to it, and there's others that at times when there's a bit more riskier, they've contracted. But what we've observed is that there is a healthy market and a growing market for this sector. And we think it's growing potentially maybe not to the level that we're seeing in Europe and the US, but even if it grows even slightly more than what we have here, there's plenty of market share to be picked up along the way.
You're in an elevator with mum and dad. What is private credit in 1 minute?
So private credit, It's lending to people for their future project opportunities, and that could be in property or non-property. We at Centuria Bass focus specifically on property only, but we'll sort of talk through the landscape. But lending to people who want to get projects done one-to-one or through peer-to-peer lending. So not going through a banking system, but finding a partner to provide you funds for whatever project you're doing on a one-to-one basis.
These are not term deposits, and I think we should be very, very clear about that. It's quite interesting because obviously we've exposed our clients into the sector for the past 5 years with different rates of return risk associated with that. And clients come out of their first or second project and then they'll say, this is great. It's like a term deposit, right? Get monthly, well, some term deposits don't pay monthly income, but I'm getting monthly income, and then at the end of the term, I get my capital back, and then we go again. These are not term deposits, right? Because the returns are broadly higher. What's the difference?
Well, in fact, it's quite interesting that the returns are actually double, or approximately double than what you might get in a term deposit. And yet it has some qualities that are very similar to a term deposit in terms of monthly distributions. If you invested through a fund, sometimes there's a bit more liquidity on a monthly basis, so it's got some flexibility. But the fact that the returns are almost double what you're getting in a term deposit, that should inform investors about the level of risk that you're taking in these underlying products. So yes, there is more risk because you're going through a non-bank, you're not going through the banking system. They're typically borrowers who have chosen to go that non-bank route. Either they've been through the banking system and haven't been able to qualify, or they want something that's a bit quicker and more tailored to what they need for their particular project. But the fact that it's not going through a bank and you're getting that return should inform the risk somewhat. However, I say that, and therefore there is more risk. But on the flip side, what investors should also take comfort in is the fact that we're putting in every single protection that a bank may have on their underlying loans with their borrowers. That being documentation that's drafted through a lawyer with lawyers on all sides. The fact that we're taking in predominantly first mortgage security and listed on title, just like a bank is. The fact that we take personal guarantees and corporate guarantees over the underlying project. That they're all the protections that banks undertake with their borrowers, and we're afforded the same protections through lending to them one-to-one without the process of a bank. But the fact you're not going through that whole system and it's not a term deposit means that your risk is concentrated with that particular borrower. So that's why you're getting a better return. You do have your first mortgage, you do have all the other securities, but at the end of the day, it's a one-to-one lend. You're not lending against a book of bank securities with all the reputational and historical and regulatory oversight that you might get with a bank and you'd come to expect with a bank.
And I guess the other big difference would be it's not government guaranteed, like a term deposit is through the standard banking system.
Absolutely.
If we turn on the other side of a transaction, right? Let's say, rates are starting to fall now, obviously. Let's call term deposits going to get close to 4%. Let's say private credit gets you 8%. That's the double that you talked about. You're making a margin in the middle of it, of course, just like a bank does against your term deposit. Let's call that 100 basis points for argument's sake. So a borrower is paying 9%. You talk to any mum and dad on the street and they say, well, I'm getting my home loan, at least before this latest rate cut was, low sixes. Who in their right mind would pay 9% per annum plus to borrow money? Like, that just seems insane.
Yeah, well, and we're the good guys in these scenarios. Like, as a non-bank, there are others in the market that may charge even more for riskier projects or other projects that they deem acceptable for their risk. I think it's worth just stepping through the process of how we do that business. And you mentioned briefly, yes, there is a margin there, but effectively what we do as non-bank lenders is we raise funds from investors. They provide us with funds and we provide a return on those funds, typically what's called high single-digit returns. We then use those funds and lend those out. We're the intermediary. We lend them out to borrowers, and we take first mortgage security and corporate guarantees and personal guarantees for lending that out. And there's typically a strategy on the other end for why that person is borrowing. And that's where we get to why they would pay. So it really depends on the strategy of the end borrower as to why they would pay. So as an example scenario may be, a developer's picked up a piece of land, he's been to the banks won't provide him funding on that because he's got a particular zoning, but he's trying to amend that zoning to get greater value against that land. It might take him 6 to 12 months through planning to get that zoning uplift. Now, a bank may say, we're happy to lend to you when you get that zoning uplift. That will be sort of our requirement for the lend. Now, he's got to wait 6 to 12 months sitting on that equity in that property in order to get that uplift, and then he can get bank funding. Or he can come to us and we might take a view of the current zoning that he's got, and we'll say, well, that zoning's one level, that we're pretty comfortable with that. There could be an additional zoning uplift, and that would make our position even further protected. But we're happy to lend a certain amount on the current valuation because we know in this market at that valuation there would be buyers for it, or there's strategic things that we could do, and we recognise the inherent value of that asset, and we can then pretty quickly come to an agreement as to what we're going to lend. And in that case, that developer may pay 9 or 10% because he knows it's going to be for 12 months. We've got a lot of confidence in the outcome of what that zoning application and what might occur, and therefore he's really only paying that 10% for 12 months. He gets an uplift in the land. The bank then takes it and takes us out, and we've all come to a satisfactory transaction where everyone's sort of happy along the way, where our investors are happy with a high single-digit return for a 12-month period. The developer's happy because he hasn't had to use his own equity during that period where he's been on risk. We're happy, we've made that margin in the middle, and the bank's happy because at the end of the day, they've taken out a de-risked asset. So it rather than seeing it as why is a developer paying double-digit returns, it's almost, well, where do we play a point in that value chain to allow a piece of land to progress through the natural cycle to end up constructing something that's useful for an end consumer. Well, if we weren't in that part of that value chain, potentially the equity in there is stuck and the developer can't get it unlocked.
Yep.
And therefore other projects don't start, or this particular project never gets developed, or the value erodes for whatever reason. So by providing that sort of rapid funding and nimble funding, even though it costs a lot more in the short term, it allows that end value to be realised even quicker, which is of ultimate benefit to the developer and to the housing industry, I guess, overall.
And so if I sort of play that back to you, effectively private credit does supply a gap in the funding ecosystem, but it is really about short-term debt, right? No one's sitting on this in the same way. I remember years ago, I had a investment property that most of the banks wouldn't lend me because of certain criteria. As a business owner, it's a lot harder to be pigeonholed. And I had to borrow money. I was offered an insane rate by Latrobe and then Bluestone mortgages subsequently. And basically my broking team said, Jonathan, we'll put you in this because just so we can settle the property. And then 12 months, we're going to get you out of there. And we ended up refinancing in this particular case to ANZ.
Yeah.
Right. Is that sort of a rough analogy, but in the developer space?
I think the average term of our loan is just over 12 months. So developers are looking at it on a short-term basis. The example I just gave was on a piece of land, but for example, a construction deal where we also lend on first mortgage and provide funds for the ultimate construction of the end product would typically be anywhere between 12 and 24 months, and that provides the construction financing at higher rates. But again, it develops the end product of which a consumer then buys, and then deleverages the facility. And when you've got a completed product as well, there are more financiers in the market that would refinance you for a cheaper rate at that point. But it has to get to that point. So we see ourselves in there for that 12 to 24 month period, and there's a strategic exit at the end, which we always assess up front, that ensures we're not sitting there ticking on double-digit interest rates, because at that point it starts to eat up at the loan-to-value ratio starts to get a little bit too high for our comfort as a conservative lender.
What are the key risks in your opinion? And then we'll talk about how you as a manager address them, because there are things like borrow default, which a bank naturally would also be dealing with. You've got liquidity risks, you've got economic downturns. What are the broad risks that would keep you up at night, and then hence factors into your investment process?
Yeah, so it's been interesting when we talk to investors about some of those risks. So, for example, economic risk. We lend against an ultimate value, which has always had third-party valuations, and again for a short period of time. So we are the lender. We're effectively the bank in this scenario, and we get paid first as taking. We're the first mortgage. We are on title. Any proceeds that come back go to us. So when there is economic downturn and you're talking about asset valuations being impacted, we actually feel at that point we are better protected against other assets, because in the equity markets you might find some it will be very volatile. Your own home that you might owe, if property valuations are impacted, that's going to be impacted. So in that economic downturn scenario, the piece of debt that you're sitting on may be the best protected. There might not be a whole lot of liquidity at that point, but it's a matter of waiting till those liquidity windows open in the market. But sitting on a piece of debt and being the bank in those scenarios means you've got first option and first rights over all those properties that you're sitting on title of. So we actually think that's there might be some shocks in the market from time to time, but it's a matter of waiting through those periods and being patient and making sure that the underlying value is there, and that's on us as manager to assess going through every deal. The liquidity issue is also, so liquidity risk is one. So we are dependent on either other financiers or end consumers or other banks to come in and take out our position after the 12 to 18 months. And if liquidity markets do dry up, then we are forced to stay in those transactions for longer, because there's no exit and our interest continues to accrue. But again, we see ourselves, because it's such a short-term period, those liquidity windows may be shut for other short-term periods, but we're not sitting in a 5-year deal or a 10-year deal when we think those windows are going to be shut at the time we need to exit, or they're going to be shut for a longer term. And again, sitting in the first mortgage position as the bank means we get paid first, so we can really sit there and we're in the box seat in terms of organising that exit or strategizing as to how to achieve that exit, even through liquidity periods that are, when liquidity dries up. Okay. Other risks in this could be that one that we consider quite often is builder risk or development risk. So over the past 2 years, we've seen construction costs that have increased quite significantly. We think they've sort of tailed off by now. Those increases aren't continuing at such a rapid rate as they were, but they were risks we had to go into a deal understanding what is the underlying cost to actually produce some of these, either buildings or subdivisions or whatnot. We had to make sure we had a handle over those costs, and that the structures that we put in place could bear some of the increased costs that might have come through. And pleasingly, I think in our portfolio at Centuria Bass, we consider that period between 2021 and 22 projects that were entered into at that period being the riskiest projects, as contracts were locked in at a certain construction price that had increases in them. Funding costs also went up from RBA rates being almost zero to being in the fours. That all happened within those projects. And pleasingly, in our portfolio, we've actually started to we either exited or close to exited a lot of those positions that we had set at that time. So we think going forward, a lot of those factors have now been built in, and especially with rates going down just recently, we think conditions are primed for future growth in the residential real estate sort of subsector, which is 90% of the portfolio that we lend against.
Okay.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
We'll talk about sort of market conditions and rate cuts a little bit later. I want you to lift up your kimono a bit, Yehuda. Can you share an example of a time, whether Bass, Centuria Bass, or previously, where a deal didn't go as planned? Can you give us, let's start with the context of the deal itself. What happened?
I will use a bit of discretion, but we will cite the example where we had a developer who was developing in one of the largest states of Australia. In the middle of the project, due to the rising costs, the builder actually went into administration. So when we lend, we always lend with the greatest amount of certainty that we can, and that means we try to lock in the costs with the underlying builder. Fixed price contracts, make sure that we're all aware of what we're going into, eyes wide open. That's still the same today, but during this period, costs had escalated. The builder could not deliver on the contract as originally contracted, just due to the increased cost and the fixed price nature of the contract. We had to sit with our developer, who had borrowed the money, and come up with a strategy as to how to exit the deal, even though we're in the middle of constructing. So we're very active managers at Centuria Bass. We've got guys who are ex-developers, ex-lawyers. We also have someone who's a partner, an insolvency partner, who sits with us. So we got everyone on board and made sure that we're actively hands-on managing this project and not just allowing the interest to continue to accrue, because at that point, what the risk is for a project that sits dormant for 2, 3, 4 months before you get another builder in, it makes it more difficult to get another builder in, and you're incurring costs all that time. So what was most important for us was to find a replacement builder to come in and take over the project as soon as possible to ensure delivery, and then we can have the end product to actually sell and then amortize our loan through the settlement of any pre-sales that had come through. Don't forget, as part of our due diligence and de-risking of projects, a lot of the things we fund have pre-sales built in, and they have sunset dates. So you need to actually build these things in a reasonable amount of time. So anytime you're sitting there waiting to get your hands onto the project and awaiting a new builder can be harmful at the back end if those pre-sales approach those sunset dates. So we're very active managers. We ended up coming in, finding a new builder that was willing to take over the project. Now, there was additional costs that were incurred, and obviously that's a trade-off with us saying of time, getting a new builder in, reasonable costs, and everyone coming to an agreement as to what that is. We're not necessarily allowing a builder to come in and charge whatever he wants, but there is a bit of leeway because we are also juggling with the time period and the situation we're finding ourselves in. So you've got to be a bit commercial as well as lenders. Is it the best builder out there? Is it the one that's charging the cheapest price? Look, hand on my heart, can't say that, because at that point there was a number of competing priorities. But what was most important was to get someone on and also have the developer and us as financiers share some of bear the brunt of some of those costs. So not about going in and saying, well, we're capped at a certain LVR and we won't go above what that LVR is. I think it's a matter of, for us as lenders, being very commercial, our investors as well, because we've got investors that have provided us the capital to undertake this project. They've also got to be commercial as well and say, okay, this is the situation we find ourselves in. Our manager is saying this is the best way forward. We're going to back that in, even though we have to take a little bit more risk. We find ourselves in the situation, but there is an exit plan and we're backing the manager to repay us and we'll come out on the other side.
To sort of clarify the relationship, I guess, with regards to developer and builder, your relationship is with the developer, right? So in this particular scenario, were you the one responsible to find the new builder, or is that the developer's job? That's something I just want to clarify.
Yeah, our relationship is with the developer, and it is the responsibility of the developer because it's his corporate guarantee, his asset and his personal guarantee. But we also have our responsibility to our investors to ensure that we can provide the exit as quickly and efficiently as possible. Typically, as a non-bank lender, we're not going in as adversarial with our developers. It's almost we want to work together with them as much as possible to achieve an outcome, because the best outcome for us and our investors is also the best outcome for the developer. All our interests are aligned, because if we're not working together, then there can be penalties, there can be other rates that can be charged, and all that is going to the developer margin and decreasing his margin and likelihood of getting a really good outcome out of the project. Now, where we find ourselves without a builder, it's not something we go into a project expecting. We've obviously done our diligence up front, but it can happen and does happen. And it's about how you manage all the expectations from the investors, developers, the new builders and everyone else on site. We find if we're actively managing that and putting it on the front foot, then we can really manage to a really good outcome for all parties. And that is something that's commercial, it's something that's born out of our capability and experience, and we've found that it's worked for us in all the transactions that we've done.
So going back to the case, so got a new builder in place, agreed on commerciality around timing, extra costs, so on and so forth. What was the outcome time-wise? And then what was the outcome for the investor?
So it added additional time to the project and additional cost to the project. So that was something that investors had to put a little more money in, take a little bit more risk.
Investors actually topped up.
Well, the investors in that particular example, there was further funds to be provided. The developer also provided further funds and collateral security. In that case, we repaid all investors. It took an additional 6 months. There was an additional 6 months of interest put in. The developer didn't really make a lot of profit, but got his capital out of the project. So, I think it was a satisfactory outcome on all parts, considering where we were and the time period we faced.
So investors got all their capital back?
Yeah, capital and interest.
And interest.
Yeah.
Okay. And so one of the unique things, just like if you own a home, have a mortgage, you default, you're going to pay penalties to the bank. How does that work in your world? And then was there penalty interest charged in this deal that sort of didn't go as planned?
Yeah, so we do charge penalty interest, but I think it's a unique way of operating in that under the documentation that we agree with our developers, there is penalty interest for defaults. Typically, we like to work with our developers. We don't like to go in all draconian and saying this penalty interest is now being charged. As I said, we want to get the best outcome for all parties, and for investors, if we were to charge penalties, and that would cause a developer to our interest not to be aligned, and for them to work off the project, that's not the best outcome for investors, because then it adds additional time and cost, and it doesn't allow for a smooth transaction. So rather, we like to work with them, reserving our rights to penalty interest. And there have been plenty of examples where we have charged those penalties towards the end when we knew what the outcome was going to look like. And there have been outcomes as well where we've returned all capital and interest, but there hasn't been further funds available to pay the penalty, and there's been cases where there's been some of that penalty that has been recovered. So it can range from not being able, and that's just a function of, on a project-to-project basis, how much is actually recoverable at the end of the day.
As a financial advisor running a family office, I would say more so in the last 2 years than in the last 5 years, it seems like every week there's a new private credit manager popping up. We've built quite extensive due diligence systems in place to go through them. And I think one of the funniest things, funny, ironic, but also dangerous if you don't know how to ask the right questions, is we've asked every new private credit manager that we've never heard of, we asked them, where is your source of funding and what were you doing 5 years ago? And if the answer to the latter question was, I was a mortgage broker 5 years ago, it's quite scary. And also what we found is if your entire book of business is funded by direct high net worth individuals, at some point if that dries up, you're also left without any new funding channels. So scale, I think, is very, very important, which is why we partner up with you as well. As a manager yourself, what do you believe differentiates between a strong private credit manager and a weak one?
It's interesting, to your point, in the last sort of 5 years, everyone has, there are non-bank lenders or private credit managers that are popping up, like you said, every week, every month. And that's been true since the business was founded in 2016 by Nick Go and Giles Borton. They're the founders of the business, and they're still the co-CEOs. And from the time that of its inception, where the two of them are sitting around the table, relying on high net wealth money, that was a challenge of the business, in that the funding sources could vary, could change, on the whims of investors for every single transaction that was being done. Now, that hasn't changed for new entrants into the market now as well. In fact, it's become even more challenging because the number of new players that are coming in, maybe backed by one or two high net wealth families, but at the end of the day, your capacity is quite limited. Where we've found a real differentiation is that we approached private credit, both Nick and Giles have strong investment banking, credit experience, strong credit managers with strong credit fundamentals, have grown their distribution, but then partnering with a larger group and becoming joint venture partners with Centuria, an ASX listed company, has been a game changer, both from the distribution capability, so not relying on one source of funds, and growing that whole channel has been a game changer for us, and allows us to go out with confidence to our borrowers and the developers out there and say, we do have sources of capital for you, which means we're in the game for a lot more deals, and we're seeing a lot more transactions as well in the market. The other thing which is actually unique for us in the Australian market is partnering with an Australian domiciled ASX listed property fund manager has been transformational in terms of providing us that property capability, that we were always lending against property, but now we're actually sitting in the same stable as others there's 450 property professionals across the Centuria Capital Group and across the country, where we can now go and get expertise in particular areas just based on where those professionals have their capability and experience, and we're all sitting under the same tent. So other private credit managers have partnered up over in the last 3 years with other offshore fund managers or banks, both local and offshore banks, and other listed fund managers, but no one's really been housed, particularly with an Australian-focused, property-focused fund manager.
Yep.
So we're really sticking to our knitting, sticking to our expertise in what we do in the property space, and our partner, who have since started at 50% partnership in 2021 and now increased to 80%, is focused solely on domestic property. So we're really, as I said before, we're sticking to what we know and what our capabilities are. It's not a fad of, okay, we're a fund manager, we're managing equities, and now we're managing this asset class, another asset class, and now we're also going into debt funding as well because it's the flavour of the month. I think Centuria identified this space as a growth space in 2021, and we did our first joint venture as a credit to them, and they've really supported our business growth. And I think a lot more players jumped in only recently in 2024. There's been a lot more M&A transactions occurred in 2024, but Centuria outlined that and found this space 3 years prior to that. So really early mover, and I think they had the early mover advantage in that in terms of integrating us into their business.
Yep.
And we've seen the benefits of that.
That's great. To round things off, let's talk about the current market conditions. We've obviously seen the first rate cut last week. How does that impact your ability to be competitive in the market, right? This is also in conjunction with what we just said. There's a lot of private credit managers in the space, different places where developers can borrow money. How do interest rate cuts impact you and therefore, I guess, investors?
Well, I think there's two sides to that, and one of the mantras that we always go by is liquidity drives pricing and terms. So the more capital that's available in the market, the more you're going to see changes in prices and terms. And we've really observed that over the market as our sector has become a bit more in focus via the media, via financial planners, via equity market volatility. That's been more investors have sought out private credit in their portfolios, and the more capital sitting in our sector looking for investment, and managers sit with cash on their balance sheet, it means either two things: either prices come down because it's competitive to deploy that capital, or risk metrics and tolerance go up, and people are willing to lend at higher LVRs in order to get capital off their balance sheets and deployed. So for us, it's been just maintaining discipline in this market, doing the types of transactions that we feel still align with our investors' preferences, very conservative first mortgage positions, not stretching the LVRs past, say, the 65% is around a baseline for us, and not stretching those to, we've lost deals in the past where we're bidding for them, where we're happy to go. We might stretch a little bit further, and we've got deleveraging capabilities, or we've got enhancements in that deal, or further collateral that we can put online to bring it down to an acceptable LVR. But on day one, we might stretch, and then it will come down a bit. And we've seen other players that have just been willing to stretch a lot further than we have, and we've had to let that go. And the same with pricing. We want to maintain a level of pricing in this market. And we've seen other competitors that have come in with lower costs of capital, either from offshore money or other sources of capital, where they've deployed that, and we've just said we can't compete.
Pass.
At that low cost of capital. The risk reward is just not there for us. So I think that's one function, and we're certainly seeing that in the market now. And I think there are parties out there with low sources and low costs of capital that are deploying at those rates. Other parties, potentially new entrants and whatnot, that are trying to get set, that are taking higher risks in order to deploy capital. And for us, it's just about being patient and staying in our lane. And going back to your original question about rates, so that's liquidity. And then the rate question in that means that I think rates are coming down, but in many ways, our game is sort of an absolute return driven. When we're dealing with high net wealth, sophisticated investors, they're always seeking an absolute return. And there are points at which that absolute return just doesn't make sense for those investors, and they will turn off that capital, that investment capital, at that point. Now, at the moment, we're talking our funds are delivering high single-digit returns, and we find that very acceptable in the market. At some point, and in 2021, we found that was sort of as rates, our rates were, or the cost of capital were going down to 5s, 6s, and 7s, that our sophisticated investor base potentially had lower appetite at those levels. But again, it is again a function of wanting to deploy the capital and where the alternative source of that capital could go and what returns they're getting in those sectors.
The other part of it and this is sort of the final question, is we have all these competing pieces of macro data in the economy, right? We have cost of living crisis here. We have, I saw a news report, I know it's, Channel 9 mass media, but they said that for the person that's on a median income of $1,400 a week in Sydney, that locks out all 347 metro suburbs in Sydney for a single person that wants to buy a property. But we still have a housing shortage. And then we've got developers going down in the last 2 years. It's sort of like conflicting data. How do you see the outlook based on, I guess, sort of broadly what I've just said? There's like good bits and bad bits, but then if you've got developers falling over, that can't be good. You've got people that can't afford the housing, but we keep building the housing. How do you see that as a manager?
Yeah.
And the outlook?
Yeah, look, on a macro basis, we take a lot of confidence in that undersupply issue. Particularly, we focus more than 90% of our business on the residential subsector. And within that residential subsector, there's a number of, there's various end products for various consumers as well. We've always been focused on entry-level product, typically avoided product that's been in established suburbs where, for example, two white-collar workers would want to buy a property. And in Melbourne and Sydney, Melbourne we're talking about $2 to $3 million. Sydney, it's probably 4 to 5 plus, because we think in any downturn that's going to be squeezed, and the mortgages that are held by those underlying buyers, should a job conditions change or whatnot, then that's where it's squeezed. And if you find that replicated over a large area, that's where you can see the valuation imbalances. But in the entry level product, we find there's bipartisan support. There's support for urban growth, both in all states really, and they're the things that we've supported in the past, like subdivision in Western Victoria, Western New South Wales, Southeast Queensland regions. They've been strongly supported, and the end consumer has. There's been a deep market of an end consumer for that. And the other thing we've liked about that is we lend, as I said before, typically in the 60s region, 60% of the end value. And this is real product that if you drop it by 5 to 10%, you unearth a whole deeper pool of other buyers that are interested in buying that property, because at that point you're talking about dropping, depending on the state, again, $50,000 to $100,000 off a lot. You've got that's actually a real saving to someone who's trying to get into that entry level market. So typically, I don't know if I've answered the question, but we think long term, the residential market will be quite strong in the states that we're lending. However, I think in the short term there are a lot of these headwinds that we've got to get through, and it starts with lowering the cost of delivery, and that can come from not only the sector itself sharing some of that pain to lower the cost, but also the governments and approval processes, which frankly have become quite unwieldy and prohibitive to developers. So I think we've got to streamline that, allow more product to come through, and if that's delivered effectively into a market that's undersupplied at a price that's acceptable, I think it'll be quite a strong sector going forward.
Yehuda, thank you very much for your time. We've covered quite a bit. We've talked about what is private credit. We've talked about the fact that it's not a term deposit. We've talked about the risks that investors need to consider. At the end of the day, what Centuria provides, or what any private credit manager provides, is not a single silver bullet. You have to make sure that you have a diversified portfolio, and that's where your financial advisor, certainly comes into play. So if anyone's got feedback, please email me at jonathan.wu@simonwu.com.au, and please remember to listen to the disclaimer at the end of this podcast to ensure that you remember that this was not personal financial advice. With that, Yehuda, thank you very much for your time.
Thank you.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.